Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business leaders and real estate experts. Past guests include Jay Connor talking about raising private money, and Darren Wong, who has 100 units under management and a host of industrial properties. Great shows from back when. Today's episode is brought to you by Chris Lyle State Farm. Chris Lyle State Farm helps you protect your most precious assets and investments, whether it's your home and auto, investment rental properties, or other valuables. Call Chris Lyle State Farm for a quick and painless phone call to potentially save double digits on all of your insurance needs. This is especially important in our current environment at the end of July, when many insurance carriers have taken or have seen significant premium increases. But Chris and State Farm have seen far lower increases than many other insurance companies. But anyways, visit diallyle.com or call his office at 918-878-7771. Today's episode is also brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping you buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of real estate ownership. So, Jacob, you know how hard it is to line up contractors to get make-readies done in a reasonable amount of time. If you don't have the scale that VanWest Partners does, you know that contractors are busy. The work seems to drag on forever, and all that leads to lost rental income. You've done rentals in the past, a ton of fix and flips, and now in your current business of self-storage, you know that there's a similar problem. But at Keyrenter, we line up our dedicated vendors so that turns can happen quickly, and we get more money back into the pockets of our owners. That's why no matter what rentals you have, single-family homes, condos, townhomes, apartments, we have the management solutions you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Today's guest is Jacob Vanderslice. We are in for a treat talking to Jacob. He is the co-founder and principal at VanWest Partners, a Denver-based real estate investment company specializing in the acquisition, development, and management of self-storage facilities. Under his fundraising leadership, VanWest has strategically deployed over $375 million in capital in value-add self-storage facilities across the United States. Jacob Vanderslice, welcome to the show. How are you?
Matt, good to be here today. We should have started recording 15 minutes ago. We've covered some good material so far.
We have, but we haven't covered the best part of it. I want to know about your general aviation experience. What are you flying? Where are you going? Let's talk turkey.
Are you a pilot?
I'm a pilot.
Dude, are we here to, we're going to kill the whole podcast by talking about aviation and everyone's going to just stop listening who doesn't care about flying.
Everybody cares about flying.
Yeah, I'll be really quick here. I started flying when I was 16.
Cool.
Got my private when I was 18. Always just been in love with anything that flies. Always loved aviation. I got an uncle who was a retired United pilot. Another uncle was a GA pilot with a nice little Mooney, which is kind of like a quick, smaller airplane that gets you around fast. Got my instrument rating in college, and I was thinking about going military. And I don't have any regrets in life, but I guess if I do have one, it's never having flown for the military. I just always wanted to and never did. And now I'm too old, barring like a, major conflict, they're probably not going to call me up to fly. So yeah, I just, I rent junky Cessnas at our flight club. There's a nice 182 turbo, not junky, but they're okay.
Yeah.
I was working on my helicopter rating quite a while ago.
Wow. And that's totally different. It's not the same. If you can fly a plane, it doesn't mean you can just jump in a helicopter and fly the rotors, huh?
Yeah, it's kind of a goat ready. You've got all these different opposing forces. You've got the cyclic and the collective, and you've got the pedals on the floor, and they're all trying to do different things. But I didn't. When you're taking off and landing in a helicopter, it's magical. But when you're going A to B, it's about the same as flying a fixed wing, and it's 3 or 4 times as expensive. Maybe I'll get back into that at some point. But yeah, I love aviation. Do you have
I love it. I've got a plane. We fly a Piper Malibu, an M350.
Nice.
It is amazing. I've got 4 kids, so it's hard for me to fit everybody in. And my parents want to go somewhere or whatever. It is getting to the point where it's a little bit too small, but it's an amazing aircraft. It's a 2020. Flying to low minimums is easy when you have a glass cockpit. It is a beautiful, beautiful airplane, and I enjoy flying it. We fly to our different markets, and we fly a little bit for the family and vacation and stuff, but it is an amazing, and we're in Tulsa. I mean, when you're in Denver, you have so many direct flights, but in Tulsa, for me to get to Nashville, where my brother-in-law and sister-in-law live, I got to go through St. Louis, which makes no sense. But hopping on 350 whiskey is is a much easier path, you know?
Yeah, it's a lot more fun too.
Way more fun. Anyways, okay, we could talk GA all day. And I do love flying. Being up in the clouds is an amazing experience. But let's talk real estate and let's talk self-storage, value-add self-storage deals. I want to ask you the first question, which is how in the heck did you get into self-storage? And then we can dive a little bit deeper into the meat.
Yeah, I mean, my whole real estate career has just been kind of a series of experiments and failures kind of over and over again. For many years, we did a lot of single family volume, which I know was the main business that you're in. We were buying at the trustee sales with our stacks of cashier's checks. And, had we known what the world was going to do, I wish we would have held on to more of them than we actually did. We sold most of it over the years. We probably did 1,200 fix and flips.
Wow.
We did a joint venture with Starwood Capital back in 13 and 14 when the institutional players got in the SFR space. That was the Wild West back then. Yeah. We've done some townhome development, some multifamily, some adaptive reuse, kind of historic preservation retail, a lot of kind of what's happening in Tulsa in the downtown area. A lot of buildings repositioned there. We looked at storage for a number of years, and I've got two partners, and one of them had built a storage facility with his family when he was like in high school, and his parents still own it. He kind of helps oversee it for him, and he's like, "Hey, we should get into storage." I don't know anything about storage. So we found a deal, and everybody that we took it to said no. And the last group we took it to said yes. So we did kind of this programmatic joint venture with a few development deals. At the time, it wasn't really an intentional pivot into a new asset class. Just, strategically or fundamentally, it was more just kind of try it out and see what happens. And it went okay. So we did some more, and that JV ran its course with its capital deployment. We wanted to keep going in the space. So we did a few single asset syndications leading up to our first fund in 19. Cool. Fund 2 was 21, and we just closed Fund 3. So we've got 38 facilities, just over 3 million square feet, about 19,000 units. Wow. We do some development, but most of the deals that we do are value-add acquisitions.
But so generally, you don't syndicate each deal individually at this point. You only do funds. You raise a fund and then you deploy it, and there's a life cycle of the fund. And how do you expect?
Yeah, we the market is not ideal right now, I don't think, to launch a new fund. Yeah. But we do have deals that we like, and we're not finding them, as often as we were a year ago, or certainly 2 or 3 years ago. So we're kind of in this in-between phase right now where Fund 3 is essentially closed. And we've got 2 single asset vehicles going right now. One's in the Atlanta MSA, one's in Jacksonville, Florida. We've deal working on in Vegas. So we're still doing deals, but we're not seeing the deal flow to necessarily justify a full new, fund vehicle. I expect that's going to change probably, Q1 or Q2 of next year. We have some better visibility into the election, interest rates, all the kind of unknowns right now. But for right now, we're just doing single asset investment vehicles, kind of between Fund 3 and the next thing.
For those of us that are uninitiated in the world of raising funds, why is this market, what about interest rates today, and this market is bad for raising a fund? Is it that people just they're parking their money in 5% yield, 6% yield opportunities, and they don't want the risk at a 9% hurdle rate or something? What about it?
Yeah, it's sentiment's generally negative, and a lot of people have been burned on specifically multifamily syndications the last couple of years. Equity wipes. I'm hearing about a lot of problems out there. A lot of it's because of floating rate debt and probably overly aggressive underwriting assumptions. But if you think about it, let's say I'm like, Matt, I can give you a 15% IRR and a 2x multiple. You might say, oh, that's pretty good. But you can get a 5% return in a treasury or a CD. Yeah. And with us, you're not liquid. You're stuck in the deal for as long as we own it for. You're junior to senior debt. So you might argue that, whether this is right or wrong, you might argue that, hey, I'm taking 10 times the risk for 3 times the return. Yeah. Right. And that 5% return is arguably guaranteed. And hopefully the return that I'm targeting, 15% over the life of the deal, is materially higher. Yeah. But that's kind of the disconnect right now, just the risk reward. And one other comment on this too, a lot of folks we talk to are, as you said a moment ago, kind of waiting and seeing. And I'll ask more detail about that sentiment, and they'll say, well, I'm going to wait till, I see better deals. And I understand that sentiment, but to a degree, you're kind of inferring that you can time the market, right? And you're also assuming there's going to be a trough. There may not be a trough.
Yeah.
The trough might have been 6 months ago.
And it wasn't, there wasn't one like in 2020, March 2020, people were like, I'll wait and see, I'll see what happens. And it never happened. And it just,
no, we were sitting in the office in March of 20 with a bunch of deals under contract. Like, gosh, what do we do? Do we keep going? Do we stop? Do we kind of see what happens? We decided to keep going, and we're smarter. I should say we're less stupid than we used to be. We've got a lot of money behind us. We're going to clean up this year. We're going to just steal deals. And it went the opposite direction, right? Single family home values, cap rates compressed. So you can't time the market. If you think there's a trough coming, maybe there is, but I've been through a few cycles, and in my experience, you don't know when the trough was until a year or two later in the review. Really, there's not a good time to buy, not a bad time to buy. There's just deals with good risk-adjusted returns, and there's deals that lack risk-adjusted returns.
Yeah. I also get the sentiment that some people are just uncertain about the future, their own cash flow positions. To your point about locking up cash for a 3-5 year period, they say, well, I don't know what is going to happen with the outstanding deals that I'm in, who's going to call capital, when are they going to call capital, what's going to happen with the adjustments to the various mortgages that I have. And so I'd rather remain a little bit liquid or keep this liquidity in to your point, a CD rather than tie up for 5 years. Yeah.
Yep. So wealth creation in this game takes a long time, and it's very slow. But if you're not in the game, you don't have the benefit of that time, right? So anyway.
Yeah. So one of the benefits of the single family rental market that we see from our clients, that's something that they talk about and like, is the depreciation, specifically being able to accelerate depreciation with cost segregations and other things. And we've talked about that on this show before in detail with folks that are experts in cost segs. Is that possible in the self-storage business?
It is. It's not as attractive as residential, especially multifamily. And there's a couple of reasons for that I won't go too far into. But one reason is when we're buying a deal, not a development deal, but a value add acquisition, depending on the market, we're generally doing a goodwill allocation for the business.
Yeah.
So we're allocating a portion of the purchase price to the business. We're allocating a portion to the real estate. And the reason we're doing that is to reduce the risk of a material assessment in our property taxes.
Yeah, sure.
So we're saving operating expenses. We're potentially getting a higher year 1, year 2, year 5 NOI because that tax load is lower. But the problem with that, obviously, is you can't depreciate goodwill allocations, right? Yeah. So first of all, you're only depreciating 70%. Actually, you're depreciating 80% of 70%, right, for the building allocation. And then secondly, self-storage does not depreciate from a bonus perspective like residential does.
It's like steel. It's like a steel.
You're bonusing the roll-up doors. You're bonusing your HVAC system and maybe the one bathroom you have, the leasing office. So it's attractive, but it's not nearly as turbocharged as residential is.
Yeah. Are there good IRS guidelines on what you can allocate to goodwill, or is it just kind of a thumb in the air?
Yeah, it's not an IRS. It's not a federal thing. It's more of a local municipality issue. If you think about it, the IRS would kind of want you.
You can't depreciate it.
They would want you. Yeah, exactly. I mean, they would want you to allocate all of it. They would want you to do the goodwill allocation versus depreciating the entire building. Yeah. So it's more of a municipal conversation, and we do a lot of kind of asking for a friend calls with the taxing authorities. Like, hey, listen, how do you guys treat goodwill allocations? How do you view those? Some don't care about them. Other markets like Ohio, for example, you might get sued by the school board if you try to do that to try and kind of claw back some of those property taxes. So it's a local jurisdiction issue. It's not really a federal issue. Right.
And just to run that to the ground for anybody that didn't understand, the idea is that if you are allocating 50% of the value of the self-storage to goodwill, then there's only 50% left that they can assess the tax base on. It would be 80-20 or whatever it is, but you'd only have 80% of the income of the taxable tax base to draw income from a local municipality's perspective.
And the assessor will see the deed transfer on the real estate price and not the goodwill allocation. So just kind of a way to save property taxes. And it generally 70-30 real estate to goodwill. Yeah. That kind of varies by market, but that's sort of a high level rule of thumb.
Yeah. What's an example, a typical example of of a deal that you'd see in value add self-storage? Like what are the numbers generally look like in a decent Midwest cash flowing market?
Yeah, let's see here. I'll give you two examples. In Fund 3, we have a deal in Green Bay, Wisconsin. And you wouldn't think that Green Bay is necessarily a place that you're heavily targeting for real estate investment, but it's got a good story. It was voted one of the best places to live, maybe just in the summertime, and lots of population growth. It kind of made sense. Rents up there are very low, and there's very little institutional REIT activity. So competition is somewhat limited, and operator sophistication is also limited.
Yeah.
So we bought a deal that was highly physically occupied about a year ago, with way below market rents, no tenant insurance in place. There's a lot of ancillary income streams and tenant insurance, probably not unlike residential.
Yeah.
And the seller didn't have any of those in place. So our value proposition was advertising more, allowing customers to lease online, implementing tenant insurance, ancillary income streams like U-Haul, merch sales, and just raising rents over time. And we've seen material NOI and revenue growth, and our physical occupancy is about the same. We're buying a deal. This is more of an extreme example in Atlanta in about a month. And the seller operates it himself, doesn't have any employees, runs it from his cell phone, and runs it from the liquor store that he owns next door. So if you want to lease a unit, you have to come into the liquor store. You can't make a payment on the website. You can't you can't sign a lease on the website. He has no tenant insurance in place. So this one is kind of a more rapid value lift in the first year, given the lack of ownership sophistication. So those are two examples that we generally see. We'll occasionally buy early stage lease up deals that were just completed. The seller hired a third-party management company to start leasing, and maybe they got to 20%. We come in and buy it at a discount from a stabilized value, and we plug in our operational platform to continue driving occupancy.
And from the Atlanta liquor store operator, does he not have a space right now that is considered a leasing office? Would you have to build on a leasing office or dismantle some 2 storage units to create a leasing office, or does he have it? He doesn't use it.
He just completed an expansion of about 20,000 square feet. So he built another 20,000 feet on some excess land. And within that expansion is a leasing office that's almost done. I think they're painting it right now and like putting in the kiosk. So he didn't have a leasing office before. It was a liquor store, but now he does. So we don't have to build one.
Got it.
CapEx on this deal is pretty minimal. I think we're carrying maybe 50 grand for signage and security and some other kind of R&M issues. But most of the value creation on this one is just more effective management. And
is the example you gave earlier, 15% IRR and a 2x equity multiple, is that typical of what you see in deals historically?
Yeah, I'll tell you, investor return expectations, despite the increase in the risk in the environment, investor return expectations should have gone down in the last year or two, not up. Yeah. So we're paying maybe a slight discount from what we were buying these things for 18 months or 2 years ago. And that's a broad stroke statement. It's all just market dependent, obviously. But the reason returns are not, IRRs in the low 20s and multiples in the mid 2s are, first of all, you're lower leverage, right? You're lucky to be even cash flow on a value add acquisition out of the gates. So lower leverage means more equity. And your interest rate obviously is higher than it was a couple of years ago, as we all well know. And we're all tired of talking about that. So returns are not, they haven't gone up. If anything, they've kind of softened. Yeah. Now, that being said, obviously we don't know each other. So believe whatever you want when I tell you this. So we strongly believe that we bring in very conservative, reasonable, and achievable underwriting assumptions, where we're not saying, hey, if everything goes perfectly, we're going to try to deliver a 2 multiple and a 15 IRR. We've sold 6 deals in the last year, so kind of well into this cycle. Mm-hmm. 5 out of the 6 materially exceeded our underwriting expectations. 1 out of the 6 very much underperformed, but it still made money. I think it did like a 7 IRR. Mm-hmm. So we're always wrong on our assumptions, but we're typically wrong in the right direction. We'll see if it continues.
Everyone's seeing increased borrowing costs. Where are you typically borrowing from? Local commercial banks, like in Green Bay? Would you find a Green Bay lender, or is this a Freddie, Fannie kind of small balance loan situation?
Well, the best debt in the world is United States multifamily agency debt. You can't touch those debt terms in the self-storage space. So it kind of depends on the product type. We refinanced a couple of our Fund 2 deals. There was one of them was really under-levered, and one of them had our one and only remaining floating rate loan in our Fund 2 portfolio.
Oh, wow.
We refinanced those into a 10-year fixed interest only loan at 6.64, which relative to today is pretty good, right?
Yeah.
10-year fixed, 6.64. But you're not going to get that loan type on a deal that's got a lot of value runway just because of a debt coverage issue, right?
Yeah.
You've got a lot of NOI growth to do. So the term sheet we got for this Atlanta acquisition is from a life insurance company. I think the interest rates in the high sixes, 24 months interest only, leverage around 60. We also have an acquisition line of credit from a ultra high net worth kind of single family office here in Denver, and that's SOFR +3 with no prepayment penalties. So that seemed like expensive debt, and relative to the last couple of years, it certainly is. But if you believe rates are going to drop, we don't know when. Maybe it's going to be September. We'll see. I think they're actually doing their press conference here now, or maybe just did. But if you believe rates are going to drop, we don't want to be saddled with a prepayment penalty when our intention is to refinance after we execute our value creation strategy.
But does your 10-year debt have yield maintenance provisions or no?
It does. Yeah. And that's kind of the give and the take, right?
But six, whatever you said, 664 or whatever you said, it's pretty, even with a.
Yeah, it's within a fund vehicle, and we've sold 3 of our deals in that portfolio, but with our remaining 11 deals we have, that blends our portfolio-wide interest rate out to 4.5%. And our next debt maturity date in that portfolio is until 2031. Yeah. So we might be upset about yield maintenance and defeasance later at some point, but I think it was the right thing to do in this environment. Just kind of lock it in, and we don't have to do anything further with our debt for a long time.
Yeah. Before we pressed record on the podcast, you were talking about some assets in Tulsa, and you mentioned, times where they had been performing better and worse. What are the general market conditions that lead to good performance and bad performance of an asset?
Yeah, these I can talk about that in the macro, but first of all, do the micro on these Tulsa deals. These things were just very poorly managed, huge delinquency rates. They were highly occupied, I think in the low 90s, but you're not a hero if you've got 92% occupancy, but 40% of your customers are delinquent, right? So it took us a long time to remediate that delinquency and kind of get some of the bad actors out. We also had some major capital improvement projects on those deals: new roof systems, new roll-up doors, seal coating the asphalt, gate systems, and that stuff can be kind of disruptive to your customer base. So all of that kind of coupled with 2023, to go into the macro side, 2023 was a fairly anemic consumer demand year in the self-storage space. And what goes up must come down, and the consumer demand of the post-COVID years could not sustain, right? You're not going to see 20% year-over-year NOI growth like you did coming out of 20 into 21 and 21 and 22.
But what caused that? That people were just absorbing price increases, or that there was much more demand? Like people were moving out of their houses into their parents' houses, and they had to actually just store stuff? Is that what was going on?
Yeah, it was all the above. I mean, if you're, let's say you're working from home now, you used to go to the office, now you work from home, you want to clear out the third bedroom, you put the stuff in the storage unit so you can have your Zoom around. People, really the fundamental demand driver within the storage space is mobility, and people moving up and down the economic ladder, whether it's a good reason or a bad reason that they need storage. As mobility increases, people need storage. Yeah. And mobility kind of stabilized in 23. The single family home market kind of froze up because of interest rates. Obviously, you know that better than I do. But this year, really starting in February through, we're recording this at the very end of July, we have never seen occupancy growth in the portfolio that we've seen the last 4 or 5 months. So the consumer back, I think. And there's a lot of nuances to that. The REITs are doing new pricing algorithms where they're more heavily discounting their advertised rate than they have historically before, but then they're more rapidly moving that customer up to market rates. And, before 2023, you might move in with the first month free promotion and your rate would stay the same for probably 9 or 12 months. And they would kind of ease you up from there. And now you move in at a huge discount, but now they're increasing you by maybe 50 up to 100% within like 3 months. So if you look at self-storage rents around the country, from a street rate or advertised rate perspective, you might say, oh man, this business is tanking. Street rates are way down. And that in and of itself is true, but what you're not seeing is achieved rates.
Yeah.
So what that operator is actually achieving an in-place rent is very different than what they're advertising.
Interesting. Does the movement, so you're saying that the price increase over the last 6-7 months, or you said from April to July or whatever it was, is because of that jumping in the rates from the promotional price to the new price, 50 or 100% increase? Or is it because, are you attributing some of that to people feeling the pinch now, the consumers having inflation having settled in over the last 18 months or 24 months, rates being up, et cetera, and that they're feeling it more, and they're having a harder time paying rent, and they're moving in with their parents now, even more so than during COVID potentially?
Yeah, it's, when the deal's going better than you expect or worse than you expect, you never entirely know why.
Yeah.
Right. There's some data points to it, but
yeah.
I think a few reasons why we've seen some of this growth this year. The storage consumers kind of back a little bit more. For whatever reason that might be, I'm unclear. People,
Yeah.
maybe people are shifting markets from jobs. They're having to go back into the city now because they were out of the city for a while. Now they have to go back to the office. But part of it too is we've gotten a lot more proactive in our revenue management team, marking rates to market more often. We're doing it daily now. So we'll do this data scrape every day, and we'll look at how long a customer's been in the unit for, what the sub-market comparables are for, say, for example, for a 10 by 10. And we'll implement just little tranches of what we call ECRIs, existing customer rent increases, across the portfolio on a daily basis. So a component of that revenue growth, I think, has just been more proactive, granular, and kind of real-time revenue management, but also just more aggressive marketing tactics, also dropping rents in some of our lower demand unit types. We'll just drop them well below market. And a unit producing some revenue obviously is better than a unit producing no revenue. Yeah. So all those factors combined have created a pretty good year so far in our portfolio. We'll see how that continues for the second half.
Do you have a sense of what the elasticity of demand is? Essentially, if I'm paying $100 for 100 square feet, how high do you have to go on that 10 square foot unit for me to consider moving to another 100 square foot unit back at the original $100 price?
Yeah,
I mean, because it costs you. The movement is like, I got to get my stuff, I got to get a truck, I've got to move all that crap out. It's like it's really painful to move.
So we've done when we do our ECRIs, we're looking at the rent increase on the customer, not only through the lens of the percentage increase, but also the dollars. So a customer paying a really low whole dollar rate can sustain a higher percentage increase than somebody paying a really high whole dollar rate. We also measure after an ECRI goes out. Who knows how accurate this data is, and whether people are telling us the truth or not. But we'll poll our customers on why they moved out, and it sounds like a cliche, but 90% plus of the customers that move out after an ECRI were going to move out anyway. Yeah. So very few of them are moving out directly because of that rent increase. And to your point a moment ago, if we're charging them $100 a month and we increase them to $115 a month for a 10 by 10, and they still need a storage unit and they don't think they're going to be there that long, it's painful to call a buddy and get a truck and move to another unit that you might be saving $5 or $10 a month on. Yeah. What's also interesting is, despite the fact the leases are month to month, the duration of our tenancy is much higher than you might expect. In our Fund 3 portfolio, we haven't owned the deals for this long, but over 50% of our customers have been storing in their unit for more than 3 years. Wow! So it's a very sticky customer base, and it's
a fifth or sixth home, fourth, fifth, sixth home. A room in your
kind of out of sight, out of mind. It's stuff they don't want to deal with. Maybe it's sentimental. Maybe it's, I'll get to that someday, and it hits their credit card or the bank account every month for $150, and it's enough to annoy, but not enough to make them kind of do something about it. Yeah. And that's our typical storage customer. They move in thinking they need it for 3 or 4 months, and then 18 months later, after 2 rate increases, they're still in there paying the freight.
Yeah. So you mentioned in the Tulsa deal, one of them was kind of poorly managed and there was low collections. What is the eviction process typically like in a self-storage?
It varies from state to state. And I'm going to sound like a dirty capitalist here, which I am, I guess. But there are no fair housing laws in self storage.
Yeah, yeah,
So the eviction process is a little more simple. And to be clear, we try to cut deals with people and work with them as much as we can. But sometimes they just go dark and their number doesn't work and they don't respond to emails. So typically, if you're call it 2 weeks late, we'll turn off your gate access sometimes sooner, so you can't get into the facility. After about 3 or 4 weeks, again, it varies a little bit. We'll overlock their unit. Let's say they follow another vehicle in, they still get in. We'll put a red lock on their unit, and then if they're still not paying, we'll auction their contents off. And the main reason we're auctioning their stuff off is not so much from the revenue from the auction, from the contents of the unit, which sometimes there's something, but very rarely is there revenue.
Yeah.
It's more to get that unit back in service to a paying customer.
Yeah.
So it's typically probably 2 months from when they roll over on you to when you can actually take possession of the unit again.
And so there's no court process. It's just you red lock it. You post a notice on the thing for a couple of days.
So,
and you
some few and far between. Some municipalities you have to go to court, and we were going to see this judge so often. He basically told us don't come back again. Like, what are we supposed to do? It's the law.
Yeah.
But yeah, most some markets you're not going through the court process. You have to do like a public notice in a little newspaper that nobody reads. Auctioning contents of this unit on this date. But other than that, it's fairly seamless.
But so if you're not able to make enough money to pay back the debt, you end up throwing everything in the dumpster, pretty much, right?
Yeah, pretty much. Well, when we auction,
which is a cost.
It's one of the we use a third party kind of auction service company to do this because it's not something we want to mess with. But one of the requirements for the auction buyer, whether they want the stuff in there or they don't, they have to empty all the contents, take it off site, and broom clean the unit.
Got it. So they're not buying at auction individual parts. They're buying at auction the entirety of the contents of that storage unit.
Correct.
And you do with it what you will, but it has to go.
Yep, exactly. Maybe there's an antique typewriter in there that they want, and there's enough spread for them to make some money on that typewriter, and get a haul away dumpster somewhere and pay for the dump fee, get rid of all the other stuff.
Yeah. All right. Sounds like you really know what you're doing. I'm not going to question any more of the history of the returns. What do people do if they want to get involved in investing in value add self storage with VanWest Partners?
Well, we certainly do not know what we're doing, but we get a little less done every year.
Step by step, little by little.
Yeah, we don't learn what to do. We just learn kind of what not to do. And we've encountered enough knots that I think by default, there's not much left to screw up.
Right.
Always love talking shop about real estate. Folks can email me, jacob@vanwestpartners.com. Go to our website, vanwestpartners.com, or hit me on LinkedIn.
And is there a typical size check that you won't go below, won't go above for investors that want to come in?
It varies from vehicle to vehicle. We have an $8 billion institutional partner in some of our deals, and we have a lot of people who have done self-directed IRA investments for 25 grand, and kind of everywhere in between. Typically, we advertise minimums of 100K, but at our discretion, we can take capital contributions that are lower. A lot of folks will come in for 50. To kind of get to know us. And to be clear, that's not a get to know you amount of money. It's a lot of money for anybody, you, myself, anybody listening included. But yeah, all different check sizes.
And one final question. You guys are known in the industry for having an amazing investor relations platform and providing transparency to clients on the performance of the assets. What are you using to do that? How often would clients expect communications, and through what media, I guess?
Yeah, we do a couple things. We provide kind of sporadic updates. When I say sporadic, I mean unscheduled. If something happens, like we bought a deal in the fund or we refinance something. We also do quarterly reports. We'll do kind of updates in between too on just little things that might happen along the way. We do a fair amount of video content with these investor updates. And one of my partners is a software engineer by training. And we also have a real-time investor reporting dashboard called Keyrenter. And this isn't a white label software program. We actually built it. And the way it works is it's got an API into our property management software. So it pulls all these different reports. You can look at historic revenue streams, net rental activity. You can go back in time as far as you've owned the asset for. You can see kind of the peaks and troughs, the seasonality. You can look at physical occupancy, delinquency rates. You can even map where all our customers live in a given location.
And that's all real-time accessible for investors in a deal or in a fund.
It is.
Wow.
Yeah. And it's, well, when I say real time, it updates like 4 times a day.
Sure,
So you might get data that's a couple hours old.
Sure.
But yeah, it's a lot of folks will log in, once a week to just kind of see what's the portfolio done so far this week, this month, how did things go? It's all graphed in a format where you can kind of understand. There's some education to kind of understanding the different metrics in there. Like our insurance penetration, that's one thing that you may not understand very well unless you kind of hear about it from us. But yeah, it's important when somebody entrusts you with their money as a limited partner. I mean, they wire you money you've never met in person before. We take that responsibility pretty seriously, and providing that real-time access to how things are going, whether it's good news or bad news, I think is important.
Good stuff. Jacob Vanderslice is a co-founder and principal at VanWest Partners. VanWest Partners is a Denver-based real estate investment company specializing in the acquisition, development, and management of self-storage facilities. Under Jacob's fundraising leadership, VanWest has strategically deployed over $375 million in capital and value-add self-storage facilities across the United States. Jacob, we appreciate you so much for being on the show today and telling us all about value-add self-storage deals. We hope that some of us can invest with you.
Matt, had a blast, and we'll schedule another hour one of these days to talk about airplanes.
Love it. Thank you.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.